This is your mortgage rate watch for Friday, December the 17th, and I'm Keith Akata with the Mortgage Reel. So, looking at the bond page, we had a great bounce off the bottoms yesterday, improving rates, and then this morning we're off to the races again. This could be a bit of a too early to celebrate and a short-lived celebration. And why we say that is because last night, with the House of Representatives passing the tax cut bills, this extension includes unemployment benefits, cuts the Social Security taxes for a year, provides tax cuts for working families, college students, and businesses. This is all great for economic stimulus, but what it does put a lot of pressure on is the growing deficit of the United States. And when you think about the deficit, how is that being funded? Where does this money come from? Well, what they do is they go and take that debt and they issue it in bonds. So if you put out a lot more supply, looking at supply and demand theory, is that if you put too much supply in the market and there's not enough demand there, then what happens? You have to push up the yields in order to make it more attractive for the demand to come back in. And when you push up the yields, homeowners, keep in mind that those yields are directly tied to those mortgage rates. So if we get too much pressure from the deficit, putting too much debt into bonds and bonds being issued to cover that national debt, then unfortunately the rates are going to see the pressure. So this could be something to keep a very close eye on. Another thing too is looking at overall the gains that we've made, they're a little bit insignificant. We've hit a floor of support, but we definitely need to have this at least as a 10-day average. So right now, if you are in a purchase, this is a great time to lock. Keeping in mind that on Fridays, normally, if you go back any time in the historical past over the last 4 weeks even, Fridays normally rates worsen, and that's just because there's unexpected knowns of the global markets, what's happening in Ireland and China, and how that impacts the market opening on Mondays. A lot of times lenders don't want to take that. Hedge fund managers don't want to keep the investment in long-terms and bonds, so they sell off their positions. Now, as we pointed out yesterday, clearly, another thing to keep in mind is mutual funds are definitely selling off. And one great indication of this is when you look at a fund like Vanguard. Vanguard sold off sharply, 3.7% since reaching its all-time high November 4th. And what this means is Vanguard, a mutual fund, they invest in bonds. And like we talked about yesterday, when these mutual funds invest in bonds, they're looking for the greatest rate of return to keep their portfolio looking extremely attractive for investors going into 2011. And in doing so, they have to reposition those assets. When they're repositioning those assets for homeowners out there, if they're selling the bonds and they're going into stocks, that's not good for us. That's putting a lot of pressure on interest rates. So keep that in mind because this is a very easy way to understand what's happening. A lot of pressure on bonds right now. Increasing deficit due to the tax cuts. It's good for the economy, unfortunately for homeowners, playing against us. The more bond supply put on the market, unfortunately, if not the demand is there, then again, pushes interest rates higher. And then last, overall, end of the year, repositioning. This has happened time and time and over again in history. At the end of the year, the stock market gets hot. Everyone pays attention to the fourth quarter, how we're going to close out the year, and what the predictions are, and the crystal ball and the genie in the lamp going into 2011 and in the new coming year. When that happens, a lot of pressure on bonds because everyone's hedging on stocks to perform, what's going to happen in the economy, what's going to happen with Christmas, what's going to happen with first quarter. All of these things, unfortunately, play against the bond market. And for homeowners, this is a direct correlation. We're not talking correlation to 10-year bonds. We're looking at the long-term debt, 30-year bonds being issued to cover 30-year mortgage-backed securities. This is all in direct correlation. So please keep that in mind. Make sure to follow us on our Facebook fan page. We got a ton of great questions over the last couple days, so we'll make sure to post those coming on Monday. And then we're also getting ready to plan our first education series on our Facebook fan page. So if you haven't liked this yet, this is going to be exclusive for the network that we have on Facebook. Please do join us. You can see any of the information on the wall. We'll be back on Monday with more breaking news. And there is something to keep in mind. We're watching Ireland very closely right now because that's become a hot button again as far as media. Media, unfortunately, selling the news, buying the fact. And that's what's happening. Have a great weekend. We'll talk to you soon.